Well, great. Alejandro, thanks so much for coming on the pod. I really enjoyed the dinner at Oso Trava's house, an opportunity to get to know you better there. And, I thought it would be a good opportunity for you to come on and talk a little bit more about DILA and, what you built over the years.
Oh, thank you, Brian. It was great to finally get to know you a little bit better as well. And definitely very happy to be on the pod. And thank you for the invitation.
Great. Well, let's just start off. DILA Capital has been around for a while. I'd say you're a pioneer in the kind of venture capital space in LatAm. And a lot has changed since you started, right? And just tell us first off, what year exactly was DILA founded? And what would you say were the main challenges back then?
Sure. So it's really odd, Brian, but it's hard to kind of pinpoint an exact date of when we started. And definitely too much has changed since we started DILA. So let me just go a little bit back, because the idea of DILA Capital actually started, Brian, back in 2005. So imagine that. I had just sold my first company, and the thing that occurred in that company, while it was pretty successful at a moderate stage, but was the fact that there wasn't any venture capital at all in Mexico at the time. So 2005, I sold my business, but I sold it because I didn't really want to sell it. I just needed capital in order to implement my business that helped me out, which is Eduardo Claven. Today, he's a partner at DILA Capital. So we've been working together for over 20 years now. But I told him, I can't believe that there's no capital available in the market for entrepreneurs. I'm sure that there's a bunch of people like me out there. Why don't we start a fund? Why don't we start a small fund to help entrepreneurs in Mexico? And he said, that's an amazing idea. So we went out, we raised $2 million, and we started looking for ideas. And what we noticed at the time was that, there wasn't exponential ideas. The ecosystem wasn't there. We just weren't ready from that perspective. And so with that money, we started a new company. So my second startup actually came out of this small fund that we had raised to invest in entrepreneurs, which we couldn't find out there in the market. So, we can say that DILA was founded back in 2005, but it really wasn't until 2012 that we started DILA Capital formally, and that we started investing in high impact and tech entrepreneurs in the region. So formally, I would say, and sorry about that long-winded answer, Brian, but I would say that formally we started in 2012, and it's been 9 years now that we've been constantly raising funds and investing in tech entrepreneurs in the region.
That makes sense. So having that experience of, as a founder, being in a market where there was no capital available, and then, going out and starting another company because you just felt like there wasn't capital to deploy, and having had the experience of, being in the shoes of a founder, how would you say that kind of, informs the way that you invest today?
I would say it informs, and it's definitely part of my DNA as an investor. So, I'm not sure if it makes me a better investor or not, but I do believe it makes me a more empathetic investor. Having been in the shoes of the founders, I know what it's like to try to raise money. I know what it's like to have to fire somebody. I know how hard it is and the struggle that you go through when things are going good and when things are not going good. I know how important it is to have advisors and how important it is to have founders with you and co-founders. And so having been in their shoes, I do believe it makes me a different type of investor. And especially the fact that, I started a company in a very different time. I'm not going to say a more difficult time, but just definitely a different time when it comes to what people think about entrepreneurship in our countries and how people perceive the fact that you don't work for a corporation, and the fact that there wasn't any capital. I do believe that, I learned a lot of things along the way that still apply today, even if things are different. And so everybody makes fun of me that I say this, but, unit economics are just so important. Margins are so important. And I know that everybody now is talking about profitability, even in, high scale tech startups. But to me, since the very beginning, when we started DILA, those are things that we obviously took into consideration in our investment strategy. And so I do believe that both in my relationships with the founders that we invest in, and how we invest, and how I, behave in a board, and the decisions that we make are all very influenced by the fact that I started companies before, and I had to run companies in very difficult circumstances.
Let's talk about that investment decision, because now you've made a fair amount of bets in over multiple funds. You've invested in some great companies. Let's just get an idea of what you look for when you analyze a potential founder or the business.
Yeah. So what I would like to talk a little bit about, Brian, and I'll get to the answer of this, is how we've evolved. Because you said, we started DILA a long time ago. We were one of the pioneers, and things have changed. Things have changed dramatically. So when we started this, I was very, very young, and I was very alone. I had my investment committee, and Eduardo was part of that investment committee, and he was an investor in the fund and always very close to me. But at the end of the day, I was very alone. And I was making investments in things that I understood in industries that I was comfortable with. And I didn't come from a tech background. Both of my startups before DILA weren't in the tech industry. And so I did a lot of investments in consumer goods. I did a lot of investments in retail businesses. And it was I think there wasn't the depth and the amount of tech startups in the region that we're seeing today, obviously. And another was, my experiences and how comfortable I was investing in certain areas. So things have changed dramatically from the view of the fund and, where that's coming from and how we invest, and the decisions that we make have evolved a lot over time, because I do believe that we've evolved as investors. Now I don't make decisions, I'm not on my own. There's a bunch of people on the DILA team that are now, many of them have grown to where they're, VPs, and they all have equity in the fund. And we have our investment committees, and we have a bunch of advisors. So we've definitely grown a lot from a team perspective, but I've also grown a lot as an investor. I've matured a lot. I've, learned after more than 50 investments that we've made to kind of have that pattern recognition. I've become more savvy in certain areas. And again, I've partnered with amazing people like Eduardo and John that bring in different areas of expertise. And so where we're at today and what we look for, I mean, if I had to really sum it up, Brian, I think we would say Team and TAM. That's kind of the way we see it. So it's Team TAM LatAm. Is kind of what we say here. But basically, at the stages that we're investing, team is still the most important thing. We invest in people, we invest in diverse teams, and we can go into more detail of how we do that, because we've tried and we've experimented with a bunch of stuff to try to evaluate teams and not be so subjective. And then the size of the market, obviously. TAM is critical in the stages that we're investing in. And so at the end of the day, Brian, I would say that it comes down to pretty much those two, team and TAM. Within that, there's a bunch that we do and a bunch that we can talk about. But again, I do believe that now we're much more obviously focused on tech, focused on region, focused on scale. In our early stages, to be honest, it was more team than anything else, and in industries that I kind of felt comfortable with that weren't many.
So of those, kind of experiences, you said you kind of experimented with stuff, you learned, you probably made some mistakes. What's the number one thing that you kind of took away from those early days of investing that shaped how the fund evolved and kind of what you become today and how your thesis has evolved?
Sure. So our biggest, I guess, learning is the importance of follow-on investments. So to give you an idea, our first fund, we didn't have practically any money for follow-ons. So we invested in the portfolio. We did 12 investments. We invested pretty much equally, a certain amount of money in each of these companies. And then we didn't have any money to follow on. That fund, which is actually called DILA but it's our first institutional fund, just to give you a little bit idea of the proportions, it was around $10 million. So it was a very small fund. We invested, equally about, $750 to $800 million into 12 companies. And that was it. So the size of the venture capital industry back then in 2014 or 15, this was very, very small. Our fund was very small. and we didn't have money to keep supporting the companies that were growing. And so we would go to, whatever, Brian Requarth or to Latitude, and we would say, hey, Brian, you want to invest in this company? And you would be like, sure, how much are you putting in? No, I'm not going to invest anymore. So terrible signal to the market. And who else is investing? No, there's no money in Latin America, Brian. We need you to come in. And the scale of the company wasn't there, and the growth wasn't there because there wasn't the amount of capital needed for these companies to scale. Fast forward to today, where our fourth fund is a $100 million fund. We're doing $1 million, $2 million tickets into the companies, but we're reserving more than 70% of the capital for follow-ons. And so what we've noticed is, and we can speak more about power law and the way, the math behind venture capital firms work. But at the end of the day, we're going to have a 20 company portfolio. We love the companies, all of them from the beginning, and they all have these amazing projections, and they all have amazing teams and huge TAMs. And we believe when we initially invest that all of these companies can make that 20, 30x return for us. And we don't know which ones are going to be successful and which are not at the beginning. But as the companies start to grow, as we participate in the boards, as we get to know them more, we start to see which companies are more successful, which companies are better at solving problems, which companies we have more fit with, which companies are going to need more capital. And when we support those, let's call them winners within our portfolio with more capital, and we end up supporting the one or two real winners in the portfolio and those fund makers in the portfolio with a lot of cash and a big equity stake, those are the ones that are going to make a tremendous difference in the return for our funds and for our LPs. And I think this took us a lot of time to really understand. We had read a lot about, how the venture capital industry works in the US, and we read a lot about power law, but it did take us a lot of time to really be able to implement the correct strategy. And I think we've done that for the past couple of funds. And while the jury might still be out, I think we've done a good job in that sense.
Do you think there's any differences between the LatAm market? I oftentimes, even if you talk to founders, like a lot of founders will be like, oh, Latin America is kind of different. I've heard some funds, believe maybe that, the market dynamics are different in Latin America. Do you think that, this is strictly a game of hits and that you've got to have fund returners every time when you make a bet? You have to be able to justify that there's going to be a fund returner? Or do you think that there can be, sorry to use a baseball analogy in Latin America here, but like, a single or a double here and, maybe a triple and then, one or two home runs. But can the portfolio construction in Latin America work with the a few kind of mid-tier companies that do well and return, 5 or 10 times, or do you need to have that kind of 40, 30, 40, 50x return in order for venture to work?
Me, 6 or 7 years ago, I probably would have told you what you've heard in the market, that, the LatAm economics are going to work differently. And I think that the reason that was in my head was twofold. One was, could there really be multi-billion-dollar companies out of Latin America that are not only operating in Mexico or Brazil, but are real worldwide companies? And if you asked me that 7 years ago, my answer would have probably been no. Today, I'm certain that is possible. And we're seeing those companies today, and we can talk about some of those companies now. So that was my first reasoning behind it's going to be impossible to have a multi-billion-dollar company coming out of our portfolio. Now we're seeing that it is possible. So that was the first. And then the second was, I think that we were a little bit risk adverse in our investments. Maybe it was because of the same thing. We were thinking a little bit smaller. We didn't have the sufficient funds to support this type of scale. But we would say, maybe this works like a private equity play where you have 10 investments and all of them return 3x. And so you're going to have a 3x fund, which is great. And what we realized is we have to take on bigger risks because the risk reward is there. And again, it took us a long time to realize that. And again, many failures that, when you look at your failure rate, even with all of the due diligence you do, and even with all of the connections, and even there's going to be failures in your portfolio, and that's natural because of the stages that we're investing at. And when, so many of your portfolio companies do fail or are not going to give you those returns, then you do need huge returns, and you do need that power law in order to return capital in a good form. And so we don't like singles, we like doubles, we like triples, but we are constantly looking for home runs. And if you cannot have home run potential, I think we won't invest, because we do believe that the laws of power law and the math behind venture capital is not going to be very different here than it is in the US or Europe.
Yeah, I think that's kind of the consensus between most investors. And if you ask, some of the most prominent investors in Latin America, 5 or 6 years ago, the answer was more similar to kind of how you perceived it. And I think that, the reality is that Latin America has, now produced some very valuable companies. And so that obviously affects, how we see it. One question I have is, you're a lot of times when you come in early, you mention these $1 million checks or $3 million checks, and then you set aside 70% for pro rata. Has there ever been any difficulties where you've got a growth investor that is kind of coming in with sharp elbows, and they're kind of trying to write a larger check and make sure they get their equity? How do you ensure that you have pro rata? Do you, in every single investment you make, do you always require pro rata? And is there ever an instance where you're unable to kind of make that pro rata investment?
That's a great question, and the answer is yes and yes. So there's always the legal side, and there's then the practical side. So from a legal side, we always ask for our pro rata rights. We usually never have a problem exercising that pro rata right, but there have been cases, and I think you nailed it, where it's the big bad private equity player that comes in and says, I want the entire ticket, and I want everybody to I don't know how you call it, but to not enforce their pro rata rights and give up their pro rata rights in order for us to have the ticket size that we need. And at the end of the day, I think that, we're obviously looking for our best interest in our, I guess, our stake in the company, but we put the entrepreneur first. And so those conversations are really tough, because it's, Brian, we invested in Latitude. We want to help you, and we obviously want to keep investing, but the big bad private equity guy doesn't want us to keep investing. What do you want? And if there's, reasons that Brian really wants, and Brian, I'm talking about the founder of the company that we backed, if they really want this private equity fund to come in, and they're going to add real value, and they are going to really make a difference in the company, and if it's a deal breaker for them that we exercise our pro rata rights, we have said no to that. So at the end, we do lay a lot the decision on the founders. It doesn't come without a fight. We obviously want to participate and want to have our pro rata rights where the company is doing great. But we have said, okay, fine, we can not exercise the pro rata rights because the private equity fund or whoever wants to come in. There's always, the possibility, and we're seeing it more and more, of actually exiting at that time. So private equity firms that come in that aggressively, they usually are open to secondaries. And so, if we can't invest anymore and these guys don't want to grow at the rates that we want to grow, that has actually created a pretty cool secondary market for early stage funds like ours.
Makes sense. I think that the reality is that founders have a lot more leverage than they think. And, if someone comes in there and, is kind of just like rough and tough with, hey, either take it or leave it, usually there's actually a lot more flexibility, and an experienced founder will know how to push back and say, look, I want to involve my existing investors. I don't want to sell too large of a stake to a new investor. And I think that like the experienced founders that are kind of in charge of their business know that there's, everything is negotiable, and that rarely do you get an offer that's like take it or leave it type situation. And so I think that for those founders to remember that they have more leverage over investors than they actually think, especially if they have a good business and they're, in a strong position. And chances are, if you have an investor coming in hot and heavy, wanting to take the whole round and not share with anyone, it can start that way. But and I think you just got to choose whatever is in the best interest of you as the founder. And so I think that I've seen that happen occasionally, particularly with like really small investors. Angel investors oftentimes aren't able to exercise or get any pro rata sometimes, and so that's something that is a bit of a challenge. Now let's talk about once a company receives investment from you, what's the value proposition? As in how are you helping the development of Latin America, as the name of the firm states?
Yeah, so this wasn't designed like this from the beginning, Brian, and I really appreciate what you guys are doing in Latitude, because you are designing it in this kind of way that I'm going to explain. But when we started DILA, there wasn't any institutional investors out there that would put money into venture capital firms. So you didn't have pension funds investing in the sector. You didn't have foundations, and so on and so forth. And so what we had to do was go with high net worth individuals, successful business women and men from across the region, and say, we're raising a VC fund, do you want to participate? Usually these types of investors say, sure, I'll participate with a small check. I'm not going to put in any type of percentage of my net worth into this. This is your first fund. You don't have a lot of experience, and I don't understand the venture capital model. So we raised money from a lot of people. If I told you the number, Brian, you'd be surprised, and it's a headache for everybody in our back office and the investor relations team at DILA. But what that created, Brian, was an amazing network. And again, it was not designed like that. It wasn't on purpose. But today we have a lot of people that are backing us with their capital, but also with their networks. And they're successful women and men from different types of businesses from all around the region. And they've become our advisors, they've become our partners, they've become our mentors, and we can leverage their networks to help the portfolio companies that we invest in. And so it's created something that I think is very hard to replicate, and it's extremely valuable, both for us as for our portfolio companies. And so when we invest in your company, we have a 90% certainty that we're 1 or 2 degrees of separation from anybody you want to do business with in Mexico. And, I'm not sure what the percentage is in the rest of LatAm, but it's pretty high. And it's not because of me or Eduardo or John or the team. It's because of the network that we've built over these years. And so that network is very, very strong. And we actually have an area in DILA that we call DILA Comercial. And what that particular group does is, how can we help our portfolio companies from a commercial perspective with both our LPs, their companies, their network, and then everybody else that we've done, business with in the past. And so that has created a tremendous amount of again, power and leverage that we're constantly giving to our portfolio companies. And so at the end of the day, what we always tell founders when they come and pitch to DILA is, this is obviously not a one-sided pitch. Let's get to know each other. And this is more of a date than it is an interview. And you have to get to know us. And we want to know, what do you want from us? And are we capable of giving you what you're looking for? And if not, we honestly prefer not to invest, because we believe faithfully that money is a commodity, and that if we're not helping the companies that we're investing in, we're better off not investing, or they're better off finding money elsewhere.
Our friends over at at Bicycle, which is Shu Nayada and Paulo Passoni. I was reading a tweet this morning from Shu, and he wrote, a lot of wealthy LatAm families are scared of investing in the future of LatAm. They want to invest in the future of the U.S. instead. He mentioned the same dynamic in Africa, and then he goes on to say, you can't expect global capital to flow to you if you don't show local conviction first. I would love to get your thought on that, and how the evolution of, I found an interview from 2016 with Diego from Dalius, and you talk about how exits and, having LPs trust, to make sure, they're going to get a good return on their venture investment were the main challenges you saw. Do you think that scenario has changed now? And you've got a few unicorns under your belt, so that probably helped. But talk about how you see LP money flowing into the venture landscape in Latin America.
Yeah, so I think Shu's right. When you talk about, and let's talk about Mexico for a second. When you talk about Mexico, the negative comments that you're going to hear are usually from Mexicans, and they're usually from Mexican families. And I'm talking about, both from a macro as well as a social, as well as a political landscape. We are the most, negative people regarding kind of auto criticism of our leaders and our economies is usually the Mexicans. And it's weird. In Mexico, we call it, I'm forgetting the name here, but it was the name
Malinche?
of...
Malinche.
Exactly, malinchismo. Yeah, hopefully
Malinchismo,
we can...
sí. Qué bueno que mis clases en la universidad pues me enseñó algo.
Exacto, Brian. So we call it malinchismo, where we're always looking up. We're always looking north. We're always looking to what's popular in the US, and, the grass is always greener on that side. And when you talk to investors, from the US, our US LPs, they're like, the opportunity is huge. You and I have spoken about this a lot, and I hear you talking about LatAm, and I hear, Andreessen Horowitz speaking about LatAm, and the opportunity is huge. And it's really tough for us to, give that conviction and to translate that conviction to the Mexican families. Now, I believe that in DILA we've done several things, and you mentioned trust. And I think that's the most important word in our business, both when we're raising capital from our LPs, when we're investing into founders. Trust is just so, so important. And we've been at this for 10 years, and families at us in general, I think we've created a lot of trust. And that is what we have to take care of every single day. Returns are not only going to be because of us. Obviously, we are a very, very small percentage of what's going to move that investment return. But what we do control completely is how transparent we are, how loyal we are, how we communicate the good, the bad, the ugly, what type of relationships we have, and, to walk the walk and to talk the talk. And so trust is very important. Once we've generated that trust, I do believe that it's been easier, and I don't want to say easy when we talk about raising capital because it's always a pain, but it has been easier as time has gone by. And obviously, as more money has been flowing into Latin America, as more exits have occurred, as more, success stories have been written, it definitely has brought in the attention of these families and more to invest. But they're still pretty skeptical. They're still, even when we have these unicorns, as you mentioned, under our belt, we've had a lot of our LPs saying, that's monopoly money. That's not, once you give me my money back at that valuation, then that's a real valuation. Or once you IPO and the public markets give you that valuation, then that's a real valuation. They still don't believe in these fictitious valuations made up by the guy that's coming in after us and valuing the company at $1 billion. And so I do believe there's a long way to go. We still have to, these big funds, DILA 3 and DILA 4, we still have to have those closed cycles where we return the capital to the LPs and actually give them cash on cash to really prove ourselves. But I do believe that it's been easier. There's a quote that I love, and I think it's Doug Leone, I'm not really sure, from Sequoia, but he said something like they were asking him how he raised his last fund during COVID, I don't know, something like $2 billion, and he raised it in 3 weeks. And he said, yeah, sure, I raised my last fund in 3 weeks. It took me 35 years. So it's relationship building, it's trust, it's communication and trust. And, I think in LatAm, we're at the right place at the right time, but it's trust.
I love that. I mean, it's always easy to take a look at someone who's been successful and just kind of chalk it up to, recency bias or, some kind of rapid story that all of a sudden took them there. But, it's the hard work that you put in, and then, you kind of pick up the fruit after you've put the work in. So, you've like any investor, and I think we all have our anti-portfolio of opportunities that we. Oops, sorry. Hold on one second. We've all had our opportunities that we've missed. I can count them probably on not just one hand, but two. I know that you saw Kavak early. You've seen most of the the big winners that have come through. How is what have you learned from missing a few deals like the Kavaks or the corner shops, and how do you get over those lost opportunities, and how do you make sure you don't miss other ones?
Yeah, so I think that's kind of one of the few things that I don't like about my job is that you can't hit them all. You're going to miss some. You're going to miss a lot. The important thing, I believe, Brian, and the way that after a lot of meditation and a lot of crying, to my pillow, is it's impossible to not miss them. What we have to make sure is that we did see them. And I think that's the most important thing. And that's kind of a rule that we've written now for DILA, which is, again, you're not going to hit them all, but they do have to come here to DILA, or we have to go out there and look for them and have seen them. And there are a lot of reasons why we don't invest, and we might be wrong a lot of the time, but you have to have seen them. And that, we always think of DILA as a startup that has to attract talent and it has to attract founders. And if we're not at their top of mind, and if you're starting a company in Latin America and you don't think of DILA as one of the options to go raise capital to, then we're doing something wrong. And again, we can have many reasons why we didn't invest in those companies that ended up being very successful. And I think it's going to happen time and time again. The two important things to understand is, one, we have to see them all. And two, we are going to have winners, and we are going to have home runs, even if we miss some. And again, we see, Brian, maybe 1,500 opportunities a year, and we're doing 8 investments on average. So it's going to be impossible to not miss some of the big winners. Obviously, we learn and we mature as investors every single day, and hopefully we'll miss less and less as time goes by. But the thing here, to be completely honest, is, if you read why we didn't invest in Corner Shop or in Kavak, which are the two examples that you gave right now, I think they're legitimate reasons. And they weren't the right reasons, obviously, or the founders were able to manage and jump the hurdles. But I think that if those companies came back today, we probably would have still made the mistake of not investing in them.
Yeah, I think that the point of making sure you see everything is super important because, like you said, it's impossible to invest in every company that may be a big winner. You've got to align with your investment thesis, and I guess there's nothing wrong with being wrong, because you're also going to be wrong on some of the ones that you do invest in, and this is part of the game, right? Like that's literally how you define venture capital. It's a game of hits. It's a little bit like Hollywood. I mean, you've got some that are going to be big blockbusters, and other ones that are not going to have the day at the box office, and that's kind of part of the game. So, it sounds like your biggest pain is if you don't get to see them. That's what you worry about.
Definitely, and it happened obviously before where you see a huge company that is being extremely successful. It's like, who saw that one? Who saw that one? Why didn't we see that? Why didn't it come to the office? And I've literally called those founders on the phone and said, "Hey, congrats on your big round. Can you please tell me why you didn't come to DILA? Is there something about us that's missing? Is there a bad rep out there? Did somebody speak badly about us? Did you send us an email and we didn't see it? What are we doing wrong?" Because again, you just mentioned it perfectly. We can't hit all of them, but we have to see all of them. And that is really, really important. And we have an investment team, out there that's looking for opportunities. Because another thing that we can't do, Brian, and that has changed tremendously since we started DILA to today, is sit at our desks and believe that the companies are going to come to us. It might have been like that back in 2013 when we were 5 investors in Mexico. But today there's so much capital from so many places. And now, geography isn't even important. You have funds from the US investing directly into Mexico, funds from Asia, Europe, Latin America. And so, competition is tough. It's out there, and we really have to make a name for ourselves and be out there. And so again, that marketing part of our job at DILA, where we have to market ourselves, where we have to create a brand and create a name, is extremely important. And then obviously adding value to the founders that we invest in, because I do believe that they are either our biggest advocates and our biggest cheerleaders or our biggest detractors. And we have to add value in order for them to recommend us to the founders that, are speaking to them. And so, it's definitely what keeps me up at night. And we're constantly working on that.
I love how the fact that if there's a deal that you miss, you didn't see, you call them and ask them. It's very like, it's very kind of focused on, you have to be kind of intellectually honest with yourself if you're going to improve, right? And you can identify those opportunities. It's probably uncomfortable, but the reality is that is what makes good investors, when you're able to kind of confront those things. And it's kind of part of the game, as we said. But if you don't go out, you could just chalk it up and be like, oh, we missed it. Let's get the next one. But the only way you can make adjustments, and this is also very relevant for founders, is like if you don't close a deal, after this phone call, I'm about to get on a sales call with a potential customer, and we're kind of at the tipping point here. If they're going to make a decision, if they're going to go with us, and you can best believe, one, I hope we close the deal, because that's. But if we don't, for whatever reason, I will spend massive amounts of time. Because you can't sit there and just, kind of blame anyone or be a victim. You've got to take ownership over the situation, and you got to look in the mirror. You got to take a hard look, and then you got to make adjustments. Otherwise, you're going to be kind of sitting in the same place, and we can't be stagnant in business.
No, 100%. And we actually do something that, I'm not sure how many other funds do, but we do an NPS every year, both for our founders as well as our LPs. And so we send you, if Brian is an LP in our fund, we send you, the NPS question. If a friend of yours is looking to invest in venture capital, would you recommend DILA from 1 to 10? And we do that for founders as well. And then you have an open question where we say, criticize anything you want about the fund. How can we be better investors? How can we be better partners? How can we communicate better? Please criticize us. And this is completely anonymous, and it's literally anonymous. And you don't understand, Brian, the amount of information that we've received that has helped us be better partners, be better investors, be better general partners. It's things that people don't tell you to your face, and they're either too ashamed to say it or whatever. But when you give them the opportunity to do so, it's been extremely helpful. And hopefully we have become better investors, partners along the way because of that feedback that we've been receiving over the years.
Yeah, you really want the bad news to travel fast, right? Because then you can do something about it. If we're sitting around celebrating our successes and then kind of pushing back on what didn't go well, that's recipe for very mediocre outcome for everybody. And founders need to have the same mentality. I think every company, in my last company, we had every 2 weeks we'd have all hands. In Portuguese, you say a pergunta cabeluda, which is like the hairy question, which is basically a question or a statement from someone in the company that was completely anonymous. And it was just like literally nothing off limits. Obviously, it needed to be kind of productive for the business, it not a complaint, but like something that concerns you about the operation. And then we'd be on the hot seat and we'd have to answer. And, that makes you so much better. And it encourages a mentality of just like, constantly, working for improvements. And so I think that's something fundamental. And I'm surprised that more funds don't do NPS. It's something that like is very standard in the startup world. And so it surprises me that I've noticed that many funds don't actually do that with their portfolio companies, but it's a real indicator, and I think for the founders listening, one of the strongest things that I encourage is for you to call other portfolio companies, and don't just call the high flying company where, that has like kind of sailed into success with the investment from a fund. Talk to the founder that's kind of, hit a couple roadblocks and kind of, just barely, bumped around and, had some difficulties, because you really understand who your true partners are when, things don't go well. And I think that getting references and diligencing other funds is also a very strong signal as a founder. When you go out and you say, hey, listen, I'm going to do some diligence on you. it also changed a little bit of that dynamic. We're not sitting back in the 2013 days when there's 5 investment funds in Mexico and it's like kind of, you got your kind of pick at the opportunities. Now it's a very competitive environment. And that means, which is good for the ecosystem because it means that all the funds need to step up and really lead with value.
No, completely. I mean, honestly, I can't be more in agreement with you. It's very important to diligence who you're inviting to your startup. This is your baby. You're going to be your life for the next 10 plus years. You really have to understand who you're speaking to. And it's not only a thing of value add or not, it's how they operate. It's how, how are they as board members? Do you want them on the board or not? And those relationships are long-term relationships. And it's very, very important for you to diligence who you're inviting to your family. And so I cannot be more in agreement with you that, I invite founders as well to understand that, again, when you pitch to funds, you also have to let them pitch to you and for them to explain, what value they're going to bring, if any, and do your homework. Do your homework because it is very important to understand who these people are and why you want to invite them. Because capital is a commodity, and more than ever, there's a bunch of capital out there for LatAm startups. And so now you get to choose as well.
Kind of closing out here, I remember that you wrote an article about how the LatAm startup ecosystem has changed and how we were seeing a tipping point, especially in Mexico. This was the end of 2021. Now we're seeing this, moment of economic instability, a bit of a slowdown in investment. Does that change that reflection you made in any way? And what do you predict for the next 12 months?
So, I do believe we're at a difficult time, and I believe that this is probably, the beginning of it. So we are going to have, a couple of maybe years of difficult macro, political, and social, I would say probably instability. However, I believe, Brian, that the tipping point that I saw back in 2021 is still here, in the sense that there's more money than ever being deployed into LatAm for tech startups. We're seeing more social capital than ever. We're seeing more talent than ever. Never had I before seen the people that used to go to the McKinseys and the JP Morgans of the world going into startups. You go to the zona, to La Roma or La Condesa, and the last thing you hear is Mexican. You hear a bunch of Spanish from all over the world. You hear, English. You hear French. You hear German, and most of these people are working in the startup scene, and that's something that we had never seen before. So when you mix capital, both money and social capital, with talent, and the amount of problems that we're seeing that in our countries that are still here, that are waiting to be solved with technology, with innovation, with businesses, it's the recipe for success. And I think this is something that we as DILA had been preaching for over 10 years. And I think 2021, from 2017 to 2021, it really opened up the eyes of the world. And a lot of people started seeing what we had been seeing pretty clearly for the past 10 years. And so my prediction for the next couple of years is that the companies that didn't have true business fundamentals, didn't have sane unit economics, they weren't going to work, but I think they're not going to work faster. But the companies that have true fundamentals, the companies that have clear unit economics, that have true technology, that have leading teams, they are going not only to thrive, but they're going to be extremely successful, and maybe so outside of Latin America. And I do believe that we're going to start to see a lot of companies that are going to be, worldwide successes. And capital is still there, Brian. I just think it's going to be a little bit more elite into who they choose to invest in. And the good companies are the ones that are going to come out stronger. It might take a little bit longer, and the investment cycles might be a little bit longer as well. But at the end of the day, I do believe that in times of crisis is when most opportunities arise. And this is definitely not going to be the exception. And so I'm still a very faithful believer in the region, in the venture capital industry in Latin America. And I think both, you and I having our fresh funds in this moment in time, we're at a very privileged position.
Yeah, I think just to wrap up here and share my quick thoughts, a lot of founders that haven't been through a cycle, they also, don't realize that, even this year or let's say next year, if things, are still kind of at the slower pace, when you compare that with where we were a couple of years ago, or even, 5 years ago, like the comparison is almost impossible because, the growth is so tremendous when you look back to when it was kind of water in the desert and, and there was hardly any, money available. And so I think that's something that it's all about perspective, right? If you kind of look at things on an annualized basis over a decade, yeah, things might slow down this year and even next year, and could go along for a little longer. But the reality is that in comparison, there's still capital is plentiful when you compare it with the time when you started, and even more so when you were an entrepreneur starting out.
Oh, 100%. And I think you hit it spot on, where people are a little bit afraid, that if you look at the amount of capital that was invested in 2021 and you compare that to 2022, it has come down. But I think it's normal for it to come down. If you look at 2021, I think, we were at a historic year for venture capital in general. But if you look at Latin America, there was something like $15 billion across something like 750 deals done in LatAm. That's more money invested in the region than the past 7 years or 10 years combined. So I think it's obvious with this enormous wave of capital that, came in for there to be a slowdown, especially when you had, this recession that we're going through, or this tough economic time. But this year is going to be the second largest year all time. And again, when you put it into perspective, and there might not be 15 billion, but there's 10 billion or 12 billion to invest, who's going to get that money? I think it's the best companies out there, and hopefully both Latitude and DILA will be part of those success stories.
I have no doubt. Thank you so much for coming on the podcast. It was great to connect, in person the other day, and now here on the pod. So appreciate it. Congrats on everything you built. It's great to see, people that were early believers in the asset class, and even better to have entrepreneurs that are, coming back and reinvesting in the ecosystem. So thanks for making the time.
No, thank you, Brian, for the invitation, and looking forward to doing more deals with you in the future.
Likewise. Vamos LatAm. Thanks for coming on.